Good morning, traders. It is Monday, the 6th of February, 2023. It's 8:03 a.m. Chicago time, exchange time, that is. Um, this is episode number 2407. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Here we are today. Risk off sentiment right off the get-go, and we have just a lot going on with Friday's just ginormous beat on the non-farm payrolls and unemployment. Here are the key macro stuff that you might want to kind of keep in mind. This doesn't impact the very next trade. It does not. We're not macro traders. We're not sitting here watching the repo market and so on. But it's important to know what's underlying, because the macro picture is like the weather patterns around the world, and we're surfers, right? They're not going to dictate how we surf the next wave, but it tells us what we may be looking for in the bigger picture, what we should expect. So there's been a dramatic shift in views between the Q4 of 2022, which was that we are very likely to have a pretty hard landing, to a soft landing possible by December, early Jan, when we started to see equities kind of pick up, to no landing at all following Friday's release. So the soft landing became more obvious and became more credible on the FOMC release. So heavy repricing of the Fed ceiling expectations to 5.1% or so. Now the end of year rate, and I just want to show you this tool. It's important for all of you to know how to get this information. This is the Fed Watch tool on the CME website. It's by Quick Strike. And if you look at this tool, you could see that the next, on the March 22nd meeting, we have a 99% probability, 475 to 50, so 25 basis points expected. Then we go to May, and we're looking for another 25 basis points, 500 to 525 is the target rate. So now we're starting to see, a little bit of a distribution here. And then we go to June, and it stops. It stops. This is what the Fed fund futures are pricing. This is what participants are pricing into the future. If you go to July, so about 50%, a little over 50% are saying pause. You go to July, and 55% are paused still. And then you go to September, 47% are paused still. And now you're seeing the distribution to the left side. There's actually more and more pricing of a cut. November, 34.6 versus 37.8 have priced in a cut of 25 basis points. And in December, we're looking at 475 to 500 as a target rate at 36.9%, an even distribution that's quite far in the future. So what this says, just in simple terms, and I'm not here to give you a crash course on macro, but what this says is the market's expecting the Fed to ease, go up a couple more times, stop for most of the year, ease off November, December, and that's what the market is responding to and is pricing. And remember, the market's looking several quarters down. So there's a lot going on there's a lot going on in this week. We have Powell coming on tomorrow for a Q&A. The expectation is that he would reiterate what he said in the FOMC, because by the time the FOMC took place, the Bureau of Labor Statistics that does the non-farm payrolls must have indicated to him that the number was going to be quite high. So we don't expect too much of a change there. But the key element here is to watch all releases that have a wage growth metric. You got to watch those. That's what the Fed is going to be watching. So they're watching The market knows that the wage growth has been softening, and this is a key factor in inflation going forward. So that's it. There's the balloon thing. There's more tension between China and the U.S. I don't know how that's going to translate into the market. And a huge earthquake hit southern Turkey, northern Syria. About 1,500 people are dead. And then Dell cutting 6,650 jobs, another tech company that's cutting. And then looking at the week, what have we got? We got balanced trade this evening for Australia, the RBA interest rate decision. Tomorrow we have balanced trade out of Canada, the US. Thursday we have inflation rate out of Germany and China. And Friday we have Great Britain's GDP, unemployment rate out of Canada, and Michigan sentiment prelim. This is a key number. That'll be Friday. Relatively light week. And of course, being as it is post FOMC, we get the FOMC parade this week. We're going to get comments from probably a lot of Fed speakers, Fed bar tomorrow, and so on and so forth. So that's that. Note the numbers here in the box. Is this right? Let me check. Okay, so note the numbers in the box. Steady, ES rotation, standard rotation, steady. The NQ having gone up to about 23, 23 and a half. The RTY has gone up. Crude is averaging 45, or the Dow is averaging 45, staying stable, and crude is averaging 28, staying stable. So we've seen, an expansion. The impulses have expanded a little bit, but we're seeing a market the volatility kind of getting sapped out of the market a little bit. Statistically speaking, for the ES, we've traded 261,000 contracts. The inventory is 100% short today, meaning that 261,000 contracts all traded below Friday's close. We have about 37 points of range with the point of control of 41.17. We tested 41.06. We have a stock zone right in that area, 41.06. And the expectation on Friday, my notes on convergent trading on Friday regarding how the ES had closed. I came back after the close to make some comments. And I said that this is another day where the delta was simply not playing along with the price action. We saw unusually heavy, very large lot selling. We'll look at that in a minute. Neutral normal close in the ES, very bearish looking to me. And I expected it to continue to drift down, especially after the European Open. And that's exactly what has taken place. So this is Friday. Quick recap. This is Friday's video. We were opening in a 41.37 area at the time, or you were trading in that area. The expectation was we would be responsive. This was the key plan for that day. We would be responsive up. I expected the market to immediately push up towards 41.70. I expected it to pull back to the 50, and I said that I'm going to be stocking the 50 for a pullback for a push to 90. Expecting it to push all the way up to 90, 91.5 was the settlement price. That was the key plan for the day. Here's what actually happened on Friday. There's Friday for you. Friday, we open up around the 41.40 area. We immediately push right up here to this 70, right? We get to 69.25, pull back to the 50, key price in this area, the 50. Look at this pullback, just beautiful. Finally breaks the last high and sets up this key impulse up. And the idea is to get long and hang in there for a retest of 91, whatever I said, 91.50 or whatever. Just beautifully traded price. But I'm going to tell you, having sitting in this trade on Friday, sitting in the setup on Friday, it really took a lot. There were several instances where it was a tick away from the stop, and it just kept struggling to hold on to higher prices, and it finally throttled up, and the rotations to the downside became minimal, with the rotations on the upside expanding, kept us in the trade, got to 70, took out the 70, pushed the high overnight, and then got to its target. And then from there, it basically failed, lower high. You have your impulse down, and it set up a pullback, a very tight pullback for a short on the continuation of the impulse all the way down. What wasn't expected is the neutral close on Friday, the drop into the low on Friday, and to be neutral. So what we did here is we broke the IB high, and now we broke the IB low, and we closed in range. We closed right inside of the IB, but this is another clear push higher and finish lower with a fairly weak low right here. So the expectation is it's very likely to continue lower in the overnight. Those are the comments that I made in the chat room, and that's what's happening. So since then, we continued to push lower. We went sideways, and then in the overnight session, once the European markets open right in here, I did expect it to drop right away. It did not. Consolidated, and then it finally dropped, and now we just pulled back to the mid, the full session mid, and are holding sideways. We have a multi-distribution overnight profile. We're opening out of range of Friday, and we are, most importantly, we are in this structure. In fact, I made a chart of it and posted it to Convergent Chat. Here it is. Hang on. It's just easier to see with the notes. There it is. So this is basically the same chart as what you're seeing in front of you. But here I'm highlighting the fact that the overnight session was down here at 4106. We are in this weak structure of single prints that was left behind on the FOMC. So if you recall, last week we talked about a move down targets what price? It's on the screen, 40.90, 40.90. And we are kind of working ourselves into that. So we've poked into the weak structure in the overnight session. We've come back above. We're trading at 115. We're actually back in it. We're trading at 115. And so this morning we're opening in this weak structure. So this is yet another morning where we have to pay close attention to how the market trades it, how it trades the open, because we want to see now that we're below Friday's range, just like we were on Friday. We were below Thursday's range. When we open, we are below Friday's range. We want to see, does it become responsive and come back in? And that sets up a pullback trade into 41, 47, 48, and then 41 up here at the point of control, 41.53 or so. Although the volume point of control is right on top of settles. So 41.47 becomes the target. Or is it a market that pushes up, rebalances the fact that we are 100% short inventory, rebalances that really quick, and then starts pushing down? And that's the trade. That's the key trade of the day. That's the trade we want to be on, because that trade gets us a target of 40.90, giving us about 30 points of range to that. And then it brings us back into this balance right here. So if we do push down into that area, now we're looking for the extended target will be 40.60, 40.50 area, the mid-century. So this is what's up with the S&P. If you want to look at it from a different perspective, there it is. You have the high here at 90, another high on the FOMC at that 90, and that becomes the launch point for this weak structure, very thin structure right here And, once we get below and into this area, it becomes very weak and we start to very quickly push into the 4090, 4080, 4060 below, and then 4050 mid-century figure. That sets up the better trade. And the way the market is set up is that we put in this high the day after FOMC, the 4209 or whatever it was. We have a lower high. And then on this day, on Friday, we opened, just read the narrative. We opened right here, we tested up, and we moved down and we closed lower. This is very weak. Okay, so there's not much science to it. I don't need a MACD or an RSI or CCI or whatever to read that. I can see the price action is that it's pretty weak. And unless it gets way up here through the double distribution high, through the FOMC high, up into the 4170 area, unless it gets up here above the 4170 area, the sellers are likely to be in control here. Okay, it can, as all markets can, it can push up, it can get to 4170, it can make new highs. But as we've discussed before, it's very likely tough for the market to hold on to anything above 4150, and it hasn't, right? So we got to 4209, boom, we finished lower. We get to 4190, boom, we finished lower. So I'm kind of just going with the trend, the old adage, the trend is your friend type of thing. And there's a lot to play with downstairs, right? A lot to play with here down below into that 4090, 4080. 4090 being the bottom of the week structure. Look at that. Look at this profile. Look at that ledge. That's a hell of a ledge there, 4090. Once it gets into 4090, it opens up 4080, then 4060. We'll skip the 70. And then below that, 4050 becomes the next key low and mid-century figure that we're likely going to test. Does that make sense? That's the narrative. Very beautiful structure. Not saying that you should be making money in this or whatever. It is what it is. The market does what it does. And there are a lot of factors that go into making money trading. It's very easy to get any of these factors wrong and lose while still being able to read the market. That's understood. You just got to follow your plan and stick with it. Okay? So, real quick, TPO detail. I'm not going to integrate these yet. Because of the FOMC day, we have this weird structure. I'm going to integrate this into the composite. Okay? Oops. I integrated it into the prior. Undo merge. Here we go. I'm going to leave this open. If we get back into Friday and start to push up and finish somewhere in here, these 2 days are now in balance with each other, and we'll create a composite from that. But until that happens, right now I'm keeping it all separate to see where the Fed is. We want to see where this is. We want to see what's beneath it, the 60 area, and so on and so forth. Okay? So I don't want to keep you any longer than that. The NQ, same story. Let's go to the NQ. Massive gains in the NQ so far this year. Got beat up pretty hard last year. But the NQ, same story. It's opening out of range. It is relatively stronger. It is not in this weak structure from the Fed. So the NQ very likely to make an attempt higher, and I'm expecting the NQ to kind of give it up. Listen, don't go into today's market. Don't go into today's market with a short bias. These are just plans. These are just expectations. The market has to prove what it wants to do. So if it's responsive and it gets into the prior range and holds on to the prior range, then prior settle is very likely. The trade may or may not be available at that point. It becomes too tight. But if it fails to get into yesterday's range and it turns over and you see that it's letting go to the short side more easily than it's pushing higher, then the odds are better for a short back down, and we're looking for the NASDAQ down into the 12,300 area, all the way down to this 12,200 that we've talked about all last week, 12,200 in the NQ. And this could happen in the NQ. This could happen very quickly. Okay. Crude had one of its largest ranging days this year. This is its largest ranging days, heaviest volume day of the year. The last time we had this much range was December 5th, and we followed that with 4 days of straight selling. Crude really failed. On Friday, it ended up testing higher, and it went right to 78. It closed the singles almost to the tick before rolling over and creating its own singles. Crude is quite weak. It's, once it fell below the 77, we expected 75, but what it did on Friday was not expected. Really $4 plus in range in one day is on the upper end of, is just beyond one standard deviation of what's expected. So very unusual, impulsive day in crude. I expect the settlement in crude to be taken out in today's session. The market's very likely to continue driving to at least Friday's low to clean up that impulse low. That's what I'm looking for on crude. Good luck, and I'll catch you tomorrow. Take care.